Joining us now to weigh in is Mainstay Capital Management founder, CEO, and chief investment strategist, David Kudla. David, good to see you.
Good to see you.
Your thoughts on markets, your take on the Fed and its impact on markets.
Well, yesterday I think we got what we expected. We got confirmation that the FOMC sees our economy as strong and strengthening, and the rate hike that we got was expected. We expected 2 or 3 more this year. What the news that maybe concerns some market participants is a more aggressive stance as we get into next year and the year after.
One of the things that I was expecting to hear more about is the Fed's balance sheet and what they're going to do about that and what the planned unwind is. And especially as investors have sort of chased yield, is the unwinding of the balance sheet going to mix up the way investors are behaving in the years to come?
Yeah, the unwind, great point. The unwind of the balance sheet may be as important or more important than the interest rate hikes. The unwind started last October, and as we continue, there's 2 problems. There's an unwinding of the balance sheet, and we have an increasing need for more
we need
borrowing by the government.
$1 trillion.
Right. So, we have been calling for higher interest rates clearly going higher as a result of the Fed. This year, quantitative easing around the world, net quantitative easing, moves to quantitative tightening, so we're going to see global interest rates rising. So the interest rate path is clear. Domestically and abroad, rates are going higher.
Now, you, I think, still like technology, is that right?
I do.
Now, is that because you think this talked about regulation is not really going to happen, or it's not going to be that heavy, or because you think it actually ends up benefiting the heavyweights?
I think that, we're looking at a small slice of the technology sector, really even a small slice overall e-commerce and internet stocks. Facebook has a problem, has a serious problem. Dagan talked about earlier on the show. The stock is down 8.5%. Will probably be down 10% this week when the market opens. But take an ETF like ArcWeb that is in these same type of stocks, high tech, it's positive on the week. And we think that the secular growth story for technology broadly still wins out, even with a problem with specifically Facebook and maybe some regulation coming and maybe a tax from the EU.
So would you buy it here on this 10% decline that you're expecting on the week?
I would wait on Facebook. I think we really need to see where this goes. We've talked about, Mark Zuckerberg said maybe we should be regulated. Hey, start with some self-regulation.
Right. I've been saying that for years and years and years as more and more of these problems developed. And this is not in the last 18 months. This is really going on for years in terms of them not protecting the people who use their service and not protecting their information and ignoring, like launching products for these users and not thinking about the consequences. I've said, hey, you're asking the government to come in your front door and the back door and through your garage, and that's exactly what's going to happen.
And they just haven't done enough in self-regulation.
Right.
It really should start there.
Right.
Now, in terms of the backdrop, you agree that earnings will still be up 18% for 2018?
Yes.
Yeah, I mean, most analysts are expecting that because of the tax overhaul, because of the fundamental backdrop and the rollback in regulations. So what ETFs do you like in terms of benefiting from that, or individual names?
Yeah, so we talked about technology, the secular growth story in technology. We also like financials. You can play that through the ETF XLF. With interest rates rising, deregulation being rolled back, we're seeing a softening of the Dodd-Frank provisions and other regulations on the banks. So we like the financial services sector.
All right, we will leave it there. David, great to see you.
Thank you.
Thanks so much, David Kudla.